Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hey everybody, Kevin Cook here. My top pick this week is AMD. Let's go to the charts and we'll look at the fundamentals too. All right, so here's the price chart, and things are awfully interesting for a lot of stocks right now as geopolitical pressures weigh on all asset classes, but stocks in particular. So, looking for AMD to find magical support again at 100. You can see how important, after we made new all-time highs above 100, last late summer, early fall, that it was key support in October, bounced off there in late January. Can we do it again? I'm a buyer here. I already own AMD. So let's look at at some of the fundamentals about why you want to continue to own AMD here. So we're on the detailed estimates page of Zacks.com. Obviously, we've got AMD as a Zacks #1 rank because they just reported again in estimates. Analysts had to raise estimates again to catch up. So if we go down here and take a look at sales and earnings growth, we've got consensus forecast for $21.5 billion in revenue this year. That's 30% growth. Just unbelievable for a chip company, right? Next year is projected to cross $24 billion for the first time, and that'll be 12% growth. We could see those numbers go up. But if we just did a valuation based on that $24 billion number, the market cap of AMD is about just under 125 billion. So the stock is trading at 5 times sales. Maybe a little over 5 times sales, but it's definitely under 6 times sales, okay? And versus Nvidia, that's why I still say you have to own AMD, because AMD can support a multiple above 15 times. And so I think AMD should be able to support a multiple above 6 times, above 7 times. So that's one thing to keep in mind. And you can see the estimates here, looking for 43% EPS growth this year, 20% next year. You can see how analysts raised estimates. They took, in the past 60 days, we've gone from $3.28 to $4 for this year. All right, so the other bit of news I want to show you is something I gave my Taser subscribers last week, where we own AMD. 2 pieces of good news that were from 2 weeks ago. 8 billion share repurchase program. I mean, they already had 4 billion on the table, and boom, they drop another 8 billion. And institutional investors love that, right? And with a company growing at sales at 30% and EPS at 43%, it's just unreal. And investors tend to like the buyback better than the dividend too. So, and then Bernstein upgraded to outperform with a 150 price target a couple weeks ago, just based on Lisa Su's stellar execution. When you talk about artificial intelligence and the advancements of these massively parallel architectures with GPU chips, and what it means for all industries, engineering, medicine, genetics, commerce, defense, that you could say NVIDIA has been a category of 1, but it's really a category of 2. There's just 2 major players, and companies want what they call dissimilar redundancy. They want to buy chips from both NVIDIA and AMD for their AI applications, so they have dissimilar redundancy. So that's why I continue to be an investor in AMD, and I think you got a great buying opportunity down here at $100. Next up is Ben Rains with his top pick.
Hello, everybody. Ben Rains here. Today I'm exploring ExxonMobil. Exxon is a well-rounded oil and gas titan that's gone on an impressive run over the past year and a half after it suffered a long slump alongside the broader energy space. Exxon posted a great 2021, and rising oil prices, along with a focus on keeping costs low, make Exxon worth considering, certainly at the moment. The initial COVID shock that set oil prices and stocks like Exxon tumbling seems light years away at this point. Oil prices rebounded in a serious way off their COVID lows to around $65 a barrel in early March of 2021. Those prices now seem really tame, with oil sitting at roughly $130 a barrel on Tuesday. In fact, U.S. gasoline prices hit a record high today, and we're at oil prices we haven't seen since 2008. And it's all happened very quickly in terms of these really rapidly rising prices. The Russian invasion of Ukraine has upended the global energy markets, and the situation has sent oil prices from $92 a barrel as recently as February 25th to these $130 levels we're seeing today, which, as I mentioned, is the highest they've been since 2008. Exxon, with this going on, is halting all of its operations at a multi-billion-dollar oil and gas project in Russia and will stop investing in the country amid the attacks. But outside of this broader geopolitical storm, Exxon has benefited overall from rising oil and energy prices for the last year and a half, amid a huge rebound in demand in the U.S. And around the world as global economies are roaring back to life. This includes everything from travel and air travel rebounding and coming back just in broader energy demand amid resurgent economies after those COVID lows. So last year, Exxon reported $23 billion in profit, which was its highest total since 2014, and its revenue soared 57% in 2021 as it swung from an adjusted loss of 33 cents per share all the way to $5.38 per share. So looking ahead, Zacks estimates call for Exxon's revenue to climb another 11% this year, all the way up to $317 billion, which would easily top its pre-COVID totals in 2019 and 2018. Meanwhile, its adjusted earnings are projected to surge another 39% this year. Plus, its FY 2022 and FY 2023 consensus earnings estimates have surged since its Q4 release to help it land a Zacks ranked #1 strong buy right now. Exxon, like most of the industry, which is great for investors, is slowing its capital spending and cutting costs, even amid the rebounding demand, instead of ramping up production to chase these current prices. Exxon said at its Investors Day in early March that it projects its savings and other improvements are set to, quote, enable it to double earnings and cash flow potential by 2027 compared to its 2019 levels. The move will also help it start returning even more value to shareholders. So with this in mind, the company announced in February a new $10 billion stock buyback program, and its 4% dividend yield at the moment roughly matches its highly ranked industry and nearly doubles the 30-year U.S. Treasury, which is at 2.2% at the moment. And meanwhile, the stock has soared 116% in the past 2 years. This easily outpaces its highly ranked industry's 75% climb and the S&P 500's 55% run. This includes a massive nearly 50% climb in 2022, which also includes a big jump again on Tuesday morning. Luckily, despite this climb, it still has more room to run before it returns to its 2014 peaks of around $100 per share. And also, despite this climb, even though things have gotten seemingly overheated, Exxon is actually trading at a 50% discount in terms of its forward earnings. So it's trading at 11.8 times forward 12-month earnings, which is a 50% discount to its highs over the last year and right at its median over the last year as well. And if we look back, it's trading at a solid discount to where it was several years before the pandemic as well. So valuation remains solid. And on top of that, Exxon is focused on expanding its low carbon businesses as part of a broader future looking endeavors as it moves towards a greener future. And that does it for Top Stocks Picks today. Make sure to check out Zacks.com/promo for a look at some of our services, portfolios, and more.